I went to the liquid fund dinner thing last night, and it was like I have never seen a more distraught group. I shouldn't say this because good people, and I'm sure some of them listen to this. People have no clue what is going on in this market. Guy to my right dumped everything. He's out. The whole market, he's out. Guy to my left just levered long. Market's down 25%, levered long. Guy across from me, he's raising for a DAT. The other guy across from me closed all of his DAT, isn't allocating to like I've never seen more dispersion between investors in the cycle, which is great. It means a lot of money will be made.
Yeah.
But it's like there's really no consensus trade right now. This episode is brought to you by Zcash. You'll hear more about them later in today's episode. Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to the Roundup. We booted Rob for the day, so we got Rob out of here after Rob's been talking about how people really like him. We're hearing different things on the show. We hear that people don't like Rob actually, so we've replaced him today with Pranav from Van Eck. So Pranav, welcome to the Roundup.
Very high chance people like me less, so still try it though.
Oh, I don't know about that.
It all depends on what you're going to say, because everything we're going to talk about for the next 45 to an hour is state of the markets, if you're bullish or bearish, and whether you get invited back or not will strictly depend on your answer here.
Yeah,
Oh,
exactly.
yeah.
Or maybe Santiago just gets booted after this haircut. What do we have going on here, Santiago?
Oh man, you ruined it. Jan, I was gonna say my favorite movie in the past 10 years. One of my favorite movies is The Big Short, and there's a scene where Michael Burry's meeting someone, and he is, "I like your haircut. Did you cut it yourself?"
Just rip on Santi the whole episode. I like that.
Guys, listen, the good thing is next week my hair grows fast enough, so this will not be an issue next week. But I was in New York, and you know the haircut's bad when people notice, and I've had now 3 people that have told me that I've gotten a haircut, so it's terrible.
This is really just a big way to get more people to watch us on YouTube. Drive the listeners into YouTube, So
self-deprecating is always a good strategy, Yeah. So
Pranav, how you been, man? It's been a while since you were on Empire.
Good. I was actually meeting someone who's in town for, I guess, the Ripple conference, and this person was like, "I haven't seen you at a lot of the crypto conferences this year," and I'm like, in our fund, especially our strategy, we're kind of like evolving our thesis a little bit and trying to see where the world is going. And I just don't think you're going to find it at the crypto conferences. I know you run a great conference, but I don't think, at least in my opinion, you're going to find alpha at those conferences anymore. So trying to do something else.
So where do you find alpha? Just out of curiosity.
Yeah. So we've been thinking about this a lot. It really started with maybe post-election, which was, we said, okay, the first thing that was going to happen in the world of crypto was legislation around stablecoins, and everyone is obviously going to gravitate towards the most obvious winners, which are the stablecoin issuers. But we kind of said, okay, well, the real winners economically are likely going to be the ones that use stablecoins the most, and where if you look at their cost structure, they have a great underlying business, and then interchange is like a big part of the cost structure. And to the extent they can really push stables through that cost structure, these things will see margin expansion and grow. So our fund can do a lot of things in public equities as well as tokens. We're kind of agnostic to the underlying instrument. So we made some sort of bets around that, which are winners of stablecoin adoption. And that has more or less started to play out pretty well for us in some of the bets we made. And so then the question we then asked is, okay, what's next, right? So the next thing is obviously Clarity Act. And even with that Clarity Act, you might get this innovation exemption, hopefully from the SEC. And all that really means to me is that kind of the Web2 fintech world can start to really engage with crypto, or things are on blockchains. And, obviously everyone's excited about tokenization and all these things. But the big unlock, in my opinion, is really going to be when great businesses can start to tokenize their stock, especially if they're kind of B2C, and they can then use that tokenized equity instrument to really grow that underlying business in ways they couldn't have. So I look at it as like a quasi new customer acquisition lever for people.
Wait,
So
Pranav, can you explain that actually? Can you go one level deeper there? So by
yeah,
tokenizing your equity, you can do things that you couldn't have otherwise done. Maybe go
yeah.
one layer deeper there. What does that mean?
Yeah. So I'll give like a really kind of dumb example of what's possible, right? And then we can kind of look at every company and say, why, what could these companies do? Um, so we've all probably gone to Starbucks. I go to Starbucks every day. I get a coffee and my coffee price have gone up. Starbucks has a ton of competition. Just pull up a chart of Starbucks equity and you'll see that company isn't doing really well. Everyone's now saying Luckin Coffee might be disrupting Starbucks because I guess you get a bunch of Luckin Coffees opening up in New York. So long story short, Starbucks is like an interesting business. A lot of mobile app users, which is kind of like a mobile wallet, um, but maybe losing market share, maybe stagnating as a business. And one of the things I think could be interesting for them is, whenever I buy coffee, I get stars and rewards, and then I have to then get a free coffee eventually with those stars and rewards. And then I essentially ask, okay, one way to maybe revive that business model is by essentially instead of giving people stars and rewards, maybe you can start giving people stock. Well, in the current way stocks are traded, it's very hard to do something like that, where you programmatically, based on a set of rules, give people equity, customers equity for being a customer, a loyal user, referring users, all these types of things. So your typical business, especially that's B2C, generates revenue a certain way and then does sales and marketing a very specific way, which, could be mostly digital, right? Taking Facebook, Google, whatever ads, um, and then has like some weird loyalty program that kind of is baked into that
Mm,
marketing and sales and marketing kind of business model.
mm,
I essentially think if companies are able to tokenize their equity and if the regulatory framework is there such that these companies can programmatically give people ownership in the underlying thing for being loyal users, that might be a better closed loop mechanism to drive a
mm.
business. Um, Again, I'm just giving you one through like this kind of
No,
Starbucks
two,
example to
two,
make it
two things
real.
come to mind there. There's actually a podcast I reference all the time, which was a very formative podcast for me thinking about the world, which is or at least crypto, which was Marco Santori. If you remember, Marco Santori is a lawyer.
Mm-hmm.
Him and this other woman, I think it was Josh Clayman, who was also a lawyer. She's also a lawyer in crypto. They did an episode with Laura Shin back in like 2017, and they were
Right.
talking about this idea of, hey, imagine they use Nike instead of Starbucks. Imagine
Yep.
Nike drop shoes, but instead of the first 50 people to get on the wait list get the shoes, it's shareholders of Nike. Well, right now
Yeah.
those are two totally disconnected worlds.
Yeah.
But one day you can connect them. So.
Yeah, totally. I think there's many other angles to kind of look at too, right? Which is if you talk to most public company CEOs who kind of, understand markets and things like that, the smart ones will say, I wish I can really have a big retail audience that follows me, right? Everyone's seen
Yeah.
what Elon has successfully done and everyone wants to sort of build a retail following. Why? Because, historically, money made its way into equity markets through a set of intermediaries. You had a financial advisor channel, or you had a hedge fund you would allocate to, or you'd buy some mutual fund, ETF, whatever, and you would make your way into the markets through those sort of venues.
Mm.
Increasingly, the younger generations, millennials, Gen Z, they like to directly allocate to companies they like. So they kind of load up a brokerage account and they buy
Yeah.
the stocks they like, right? So the holy grail for most public companies, in my opinion, is to get a retail following because that means a lower cost of capital. What's a great way to get a retail following, especially for a B2C company? Well, make them owners of your thing, like for being users of your product.
Totally. Totally. I'm actually reading Andrew Ross Sorkin's book, 1929, right now. Have you? I don't know if you guys have seen this, but
I started, yeah.
I'm like 3 chapters in or something, and they just started talking about this guy Charles Mitchell, who was he was like an American banker. He ran First National, First
Yeah.
National City Bank, whatever it's called, which became Citi, and he's widely regarded as like his securities policies are basically like very risky securities policies led to this speculation, which caused the crash of 1929 and the Great Depression. And one of the things that he did is he made it he basically privatized shares of the bank and made it so that the only way to buy and sell the shares were if you talk to salespeople at his bank. Right. So instead of trading publicly, it was so his sales guys would go around to their customers and be like, hey, you should take a loan out, you should get a mortgage with us, all the normal things, and you should buy our stock.
Yeah.
And so it'll be interesting to see what happens if, like, yeah, I don't know. Imagine Salesforce like, I don't know. Imagine
Yeah.
Salesforce salespeople were selling the CRM and selling the Salesforce stock. So
Yeah, I think it's going to be harder for B2B because it's less of a relevant factor, right?
yeah.
B2C is kind of like where I think the unlock could be. So anyways, like back to like where I think things are kind of going and where it's interesting to spend some time. we laid the case that half of all U.S. companies, public companies, are tech companies, and a third of the S&P is tech. A lot of them are B2C. Most things happening around AI today is also B2C, and to the extent these companies are able to tokenize their stock, perhaps they can grow differently or grow faster. And I
Yeah.
would rather sort of focus on those companies to maybe look to invest in those things than token number 25 to 30 or whatever.
Yeah. Let's shift gears a little bit. Santi, I don't know if you're still in New York, but we're either all in New York or you were at one point in New York, semi recently.
West Coast.
And
West Coast.
West Coast, nice. What's going on the West
I
Coast?
avoid a lot. Elections are not as dicey as in New York, which
Santi's
is
like,
maybe where you want to
Mamdani
go.
wins. I'm never stepping foot in New York
Listen,
again. I'm moving to Palm Beach.
you not a bad area, but you could have seen Polymarket last week, and you would have been right. So again, it was great tweet by Shane. I think it was Josh Wolf, who's been on this podcast. Much respect for Josh, who's a great investor, but he was being a bit critical of Polymarket and prediction markets. But again, Polymarket called the election. I think it was right across all 5 counts,
Yeah.
particularly in New York, which is we should talk about though. Are you guys
By
going
the
to
way,
move over to the West Coast
so
or
were the
Miami?
polls. Just so are the polls. The polls were right too. It was just that Josh said that there are big foreign buyers, like tipping the skit, which was
That's right.
a
Yeah,
little conspiratorial.
Josh even insinuate that there was market manipulation and like foreign buy, like Russia and China interfering with Polymarket, and it's like,
So
yeah, conspiracy theories about it.
if you guys are game, let's talk
But
about Mamdani.
dude, just for a second on that, like
Yeah.
in either prediction market platform, for these election markets, you tried to buy more than a certain amount, you would meaningfully move the price because the order books aren't that liquid, because like most market makers, like traditional market makers, like to provide deep liquidity when you can hedge that risk away. And in let's say non-sports markets and these things, you can't actually hedge that risk away, right?
No, but that's what he was saying happened.
Yeah.
He was saying a small amount on Mamdani made it so that Mamdani was sitting at 95%, which then dissuades people to vote for Cuomo.
I would take the other side, which is if like the Mamdani market was completely mispriced for some reason because someone was messing around with it. Like someone else, like there are rational enough actors out there that will take advantage of that because, So my point is like, I can make the case either way.
That's why he was wrong. Yeah. All right. So Mamdani won, obviously. He got 1 million votes, about 50% of the votes. Cuomo got 42% of the votes, 850K. And then Curtis Sliwa, the Republican, got 150,000 votes, 7%. I love that there's 150,000 New Yorkers voting for Curtis Sliwa. What are you guys doing? Anyways, Pranav, I would love to just as a person who lives in New York, like, you don't have to say like who you voted for or anything like that, but just would love to get your general take on Mamdani winning if you're comfortable to go there.
Yeah, no, I won't make any political kind of statements. I observe and I kind of like, let's just say from what I see from the observation. So there was a Atlas poll out over the weekend that I think was like on social. I was going through it. And one of the questions that kind of was interesting was, what are the issues that people most care about in New York City? And the top 3 were like inflation, cost of living, crime, and housing affordability, right? And I know we were just talking about this, before the pod started, but we're talking about that old Peter Thiel email that's being circulated now on social media that the Peter Thiel email to Zuck, which basically explained why. Yeah, there you go, that one, right?
Maybe let me read it for people who are listening on like Apple and Spotify and stuff like that and can't see it on YouTube. So Peter Thiel, there's a Peter Thiel email to Zuckerberg, Nick Clegg, Antonio Lucio, Sheryl Sandberg, and Mark Andreessen, January 2020. Subject line is millennials. Says Nick, I certainly would not suggest that our policy should be to embrace millennial attitudes unreflectively. I would be the last person to advocate for socialism. But when 70% of millennials say they're pro-socialist, we need to do better than simply dismiss them by saying they're stupid or entitled or brainwashed. We should try and understand why. And from the perspective of a broken generational compact, there seems to be a pretty straightforward answer to me, namely that when one has too much student debt or if housing is too unaffordable, then one will have negative capital for a long time and or find it hard to start accumulating capital in the form of real estate. And if one has no stake in the capitalist system, then one may well turn against it. So,
yeah. And I think my sort of common thread between the election and this email was sort of this observation that the younger folks who have a lot of student debt and can't afford to pay for a nice apartment and then kind of are living paycheck to paycheck and whatnot, um, have like maybe two outlets. One is go vote a certain way, and the other outlet is gamble your way out of your situation, right? And that gambling can take form in the form of prediction markets. Used to be tokens, used to be meme coins. Now it seems to be potentially in AI equities, right? So there's always sort of this gambling energy that's coming from the younger people. And so my kind of market observation is, when I think about sort of like where are the best trades when I look into the future, it's really around finding situations and narratives that potentially have good fundamentals but are about to get that sort of retail attention, and that's what's going to drive flows, because there is that really high level of sort of leverage energy that wants to get into these types of situations.
There's a similar tweet that Naval posted yesterday, I believe, and he said, "It's not the politicians, it's voters," and says, "Importing voters is a loophole in democracy." And the last one I just tied to this says, "I fear the day when the majority of voters don't have children." Um, I think about that a lot. I think you could have diagnosed this phenomenon. Pranav, you and I privately have spoken about, like, okay, if you're an investor and you look at this rise of socialism, how do you translate that into expressing an investment thesis? I think that's perhaps a more
Yeah,
relevant discussion for this podcast, because we're not a political podcast. I don't want to get into the politics of why he got elected. It's more of, what do you do with that? How do you
yeah.
express a thesis? Um, that's sort of what I was thinking about. Okay, it's like, what are the sectors that are going to do well? If this microcosm of New York is a pretty big hub, if that is true for the rest of the country or in the world, what are the sectors that do well under this regime? What are the sectors that definitely don't do well? There's another tweet that said, "Gosh, I think it's Rex Capital, which is a bit unhinged account." I said, "I can't believe they elected a terrorist communist in New York, and Bitcoin's not at like $1 million." Interesting take, a bit taken to the extreme, but
Yeah.
again, maybe the first question is, does this make you incrementally more bullish or bearish on an asset like Bitcoin? And then what about stocks and other sectors of the economy, of the market?
Yeah, I think there have always been these geopolitical events that happen and people are like, this is bullish crypto, right? And I think, I don't know if that's like always like the knee-jerk reaction. It's like, oh, COVID's happening. This is bullish crypto. Like,
And it
so
was.
so
And it was.
And it was.
yeah, I guess it's just all about time, right? Like February of 2020, nobody wants to go buy
Yeah.
crypto when there's like a lockdown coming. But
Yeah.
but I think one knee-jerk reaction might be, this is potentially bullish things around privacy and crypto, because you know um, there might be a cohort of people that think that they want to have assets in self-custody that they can also have privacy with.
Oh, I
I
don't
can
know if
make
that's
just
yeah. My case would be that people are very disillusioned with the system, and that
Mhm.
there's people are really losing faith in capitalism. And part of the backbone of capitalism is uh, slow, and it's kind of like slow and steady. Like the S&P, goes up 7 to 8% a year. If you just put your money in two things, real estate and the S&P, then you'll be fine. And clearly, there's people can't access the money to get into real estate, and B,
Yeah.
you don't have people don't feel like the 7 to 8% gains a year in the S&P are enough money. So the things that I think, like, to answer Santi's question, in my opinion, it's fun, like fast money. Like clearly society wants fast money, perps, gambling. Like I don't actually think this like financialization is of everything is good for society necessarily, but I do think it's going to play out because people want the 100x. They'd rather have the 1 in 200 shot of getting 100x, which is bad odds, but they'd still rather go for that than just put their money in the market and get 7% a
so,
year.
so let me maybe say, I think we're all kind of maybe saying the same thing. So Howard Lindzen, who's I think pretty good,
Yeah.
VC, has a thesis, which is he kind of wants to invest at two tails of the market. One is what he calls the luxury economy. The one is like the degen economy, right?
Yeah.
So you can take the same framework here, which is, okay, this election happens. What does the luxury economy do? The people that live live well, that have wealth, they look at this and say, what could come in 2028? Could you get a socialist president? You get a socialist president, you get, I don't know, a Bernie Sanders equivalent who wants to do a billionaire wealth tax, those types of things. Then that market might want assets that are privacy preserving. So that's one angle. And you're kind of pointing to the degen economy, which is that's been there and it's going to continue to persist, which is people want to express their dissatisfaction with the system by gambling out of their current situation.
Yeah. Speaking of, anything else on Mamdani or this kind of stuff?
So just in summary, Pranav, Yano, you both are saying, look, this with the Peter Thiel commentary is markets on everything. That's bullish because people will always want to gamble to get out of their situation, because this election highlights the dissatisfaction with the establishment. Whatever the current regime is, you hate it because your and has not improved over the last 3 to 4 years. So you're going to vote for something that represents the opposite, whether without thinking much of, is this person actually going to help? It's just, I'm so dissatisfied because over the last 4 years, my wage hasn't gone up, inflation's gone up, my situation's not improving. I see all this wealth inequality and like engineers that are making $1 billion, and I am actually can't go to Whole Foods or whatever, like the supermarket, and like I'm feeling the pinch. And so that naturally translates into deep dissatisfaction with whoever the current elected official is. But you're always going to go and gamble and take the 100x, 50x perp because I'll just roll the dice and hopefully get out of this rut.
Right. And I think maybe to add to that, AI is going to make this problem potentially way worse, because this is a young people problem today, right? The 20-year-olds and 30-year-olds especially feel like they are worse off as a generation versus their parents. So, and if you,
but emphasis on feel worse off, but not, is that more of a social phenomenon of social media and your perception? Because the comparison is like so much in your face, but the reality is, like, I think there's a great book, better part of which I forget the name of the book, but it talks about like objectively the world is a safer place. Like technology's been disinflationary, it's abundant. Like our condition is actually way better than our prior generation. So you shouldn't actually feel dissatisfied, but because you're comparing yourself constantly with people, you just feel miserable and you feel like you're actually worse off.
I think it could be both. I mean, there's like sort of like I've seen some data around, home ownership as an example, right? Because home ownership used to be viewed as sort of the thing that you should aspire for, and like the prior generation probably bought homes at a younger age than the current generation is, and maybe that's like shifts in behavior. People would rather rent and go to Coachella than buy a home, but yeah, it could be both, right? Social media making you feel like you're always kind of behind, but also that people don't feel the upward mobility, because that's what people want. They don't want to stagnate in some ways.
You guys are American, but maybe just to round out this discussion, do you feel like the American dream is alive and well today, or has that been not as alive as it was 50 years ago?
What do you think, Yana? You're younger.
I don't think it is. I mean, what's the American dream? American dream is a white picket fence, a home, and two kids and a nice family, right? And you can't get that anymore. For most people in America, you can't get that anymore. It's very hard, right? Like it's very hard to have to. I mean, you definitely cannot buy a home. Like then the data shows that, and even having kids, like. I mean, I don't know if Pranav sees this, but like at least my friend group in New York, like I'm around the age when people are starting to have kids. I think when my parents were our age, it was very normal for people to have 3 or 4 kids. Now, like if you have 3 or 4 kids, like if you have 4 kids, that is like you are rich. Like that is a luxury. Like it is a luxury to have 4 kids. It is like a status symbol, and it didn't used to be that way. Now it's like I have a lot of friends who are like, I'm just gonna have 1 kid, or maybe I'll stop at 2, and that's a money thing. So.
But Yano, most of your friends cluster in New York area.
Yeah, that's the counter is that I'm in New York and San Francisco, which are such money focused areas that people obsess over money so much that it actually inhibits them from like, whereas, you know, I've friends in like middle of the country too. Like I have a friend in kind of outskirts of Ohio, and that dude's gonna pump out like 6 kids, and he's not thinking
Well,
about
there's
he's not thinking about
well,
money. Like,
and so I think there's a couple of theories I have. One is like um, home ownership and like the willingness to have a family is alive and well. You actually can. I think the American dream is very alive. I personally was a benefactor of the American dream. I went to college in the US.
mm,
Um, I got a scholarship from JP Morgan. I worked my tail off there, and then I ended up doing other things after that. And that to me is alive and well. Like you can talk about immigration, you can talk about visas that on the margin are a bit more difficult, but I I think America continues to be the best place in the world because you have upward mobility like no other place in the world, and you have this cultural willingness to take risk without being totally detrimental if you fail. That is not true in Japan. That is not true in Europe. That is not innovated over the last 100 years. That is not true where I grew up in Mexico. So that willingness to take risk is why people emigrate to the United States and decide to build their companies there. And I do think like this I mean JD Vance, your current vice president has a great book. Go read it and talks about this idea. It's just I think people just have now this sense of entitlement, which is social media, for better or for worse, just people are willing to does they feel that they deserve to have the vacation in Europe and they feel that they deserve luxuries that is like, no, dude, go fucking work hard and maybe, you know, and it's not just working hard. Like there is luck in a lot of these things, right? I'm not trying to be harsh or anything, but I do think that there's this prior generations. The biggest problem with our generation is this lack of committal. Like we're non-committal. We're always trying to optimize, but we're not willing to commit. You know, you're not willing to commit on a partner. You're not willing to commit to have a family. You're not willing to commit to settle down because there's always the elusive, can it be better on the other side? So I think that is a
yeah.
phenomenon has been pretty detrimental to our current generation versus our parents.
So let me ask you guys a different question because I guess people are hoping we hear about crypto, but um, you asked about the American
like
dream.
this Pranav guy's not passing the bar so far.
All right, you asked about the American dream. You guys have been in crypto for a long time. Is the crypto dream still alive? And I'll frame it this way. So, you know, I've more or less kind of been in the space-ish since 2017. And it always felt like crypto had this great call option, like a lot of promise that was underpriced and a variety of catalysts in the horizon that could price it appropriately if everything starts to deliver. And until, you know, last election, the thing that was the catalyst was like regulatory clarity, right? So we're like call option on something great and clarity equals everything's going to be great. As we sit here today, is that dream alive? Or was the option always mispriced?
For the first time in crypto's history, there are now 2 factions. There have always been 2 factions, and for the first time in history, those factions have completely switched on how they'd answer that question, Pranav. So 2009 until 2025, you had institutional, traditional people and crypto, cypherpunks and things like that. And we know how they would answer that, right? 2025 happens, we get regulation, this year happens. I think if you ask most people in crypto Twitter, is the dream still alive? They would say no. And I think if you ask the Collison brothers at Stripe and you ask the AI, you know, executives and you ask policymakers, is the crypto dream alive? They would say absolutely. It's actually never looked brighter for crypto. And that's why this is such an interesting year. And that's why I'm actually extremely excited about next year and I mean the next decade for cryptos because if you can just close down crypto Twitter, there's never been a more exciting time for crypto. And I know it doesn't feel that way.
Yeah.
Prices are down. It's a shitty week.
Well,
Like we
I
all
think
get
I was going to agree with this. Kind of goes back to what I was saying with where our fund is focused, which is perhaps the dream is alive, but it's not on Coin Market Cap's top 100. It's
Yeah,
somewhere else, right?
it's on
uh,
Blockwork.
I mean, Pranav, you and I share this, and we've had this conversation. I think the more value is going to be created in crypto, not necessarily in tokens, not necessarily in your infra play, but more so on companies that are using this. And you've spent a lot of time in the public markets. Companies like Mercado Libre, companies like Nubank, companies like Robinhood and BlackRock and JP Morgan's, companies that have distribution. In the same way that people are excited about AI.
Yep.
Again, question. Would you rather invest $100 million in a AI startup in a basket of startups, or would you rather invest in maybe Google or a Tesla or companies that are going to utilize AI?
Mm-hmm.
And I appreciate like the public names have different components, right? You've been a very big bull on Tesla in your private book, but like I'm curious, what I'm trying to say is like, do you think
Yep.
pick today, would you rather invest in the top 5 crypto coins of your flavor or a public basket of companies that are going to utilize and become crypto enabled?
I'm definitely in that latter camp, right? Of find great businesses that have a great CEO founder that's very focused on continually optimizing their business, and then who can naturally use this technology to accelerate what they're doing. So like there's a wrong way to do it, and there's a right way to do it. If I keep it simple, right? The luxury brands in the last cycle that were like, okay, how do I do an NFT thing? Because it seems like everyone's doing NFTs. Like that was the wrong way to do this stuff. And then the right way to do it is exactly what Yano said, which is what the Collison brothers are doing, which is they understand this technology and understand their business and where that's going, and they understand how they can leverage pieces of the stack to
Mm-hmm.
just accelerate their thing. And so I'm very much in the camp of let's find those things.
Mm-hmm.
I think so. We've been up and running now for 3.5 years, and I think the fund's done pretty well. And I'm not allowed to talk about returns and whatnot, but I look at sort of our annualized return since we launched, and I've set that as our hurdle, which is any idea that I put in our book, I have to believe it's going to compound at least at that pace, if not better. And when you look at tokens through that lens, when you look at these big companies through that lens, I think the world gets smaller and smaller. So you'll end up with like a more concentrated book of what you think are the winners.
This episode is brought to you by Zcash, the decentralized digital cash that is encrypted to ensure agency and safety. With a fixed supply of 21 million and proof of work consensus, Zcash is encrypted Bitcoin. Buy, store, and spend encrypted Bitcoin using the Zcash-powered mobile wallet, Zashi. To find out more, visit their website or click the link in the show notes. Thanks to Zcash for making today's episode possible. Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Let me ask you a couple series of questions. You tell me what you prefer, yes or no. Ethereum, 500 billion asset, PayPal, 65 billion. Which one? You can only, by the way, you can only hold for the next 5 years. One.
So my compliance people will tell me I can't comment on individual assets that way, but I would just say most layer 1 blockchain tokens have valuations that make no sense to me. Like relative to what they're going to earn in economics in the future.
Mm-hmm.
Especially looking at what people with distribution like a Stripe are doing, like it just makes no sense why these assets are valued where they are.
Mm-hmm.
Now you ask like a crypto person why they think it's valued there, they'll be like, well, there's a store value element. I'm like, dude, nobody thinks about this thing as store values.
So again, do you think, again, the question, Yano and I, you would have heard us say 5 years ago saying, hey, the top 10 in crypto is going to totally change. But we're in a state of the world where Ripple just raised at a $40 billion valuation equity. XRP trades at 150 billion. Ethereum trades at 500 billion. Solana is 100 billion. Do you think that people are doing the fundamental analysis? Do you think that that will continue to be, these things are going to trade on some sort of cash flowing basis? Or are people just going to buy these things because they are going back to why people express their political views, because for them it's like a levered NASDAQ. I'm like, I'm going to roll the dice on this token.
It's an interesting question, right? So let's ask the question differently. So since, I don't know, pick a time frame, since 2022, pick a basket of your 10 favorite tech companies, and then pick a basket of your top 10 L1s. My guess is those 10 tech companies' equities are just massively outperformed your basket of 10 L1s. Again, in like the
highly
last couple years.
subjective, highly subjective on like quite literally the month that you
Right. Hey,
pick
if you
that.
pick from
But
the bottom of
on
December
a
22, maybe not, right?
risk adjusted basis, 100%.
Yeah. So I asked I'm less focused on whether people will own an L1 token for a variety of reasons, YOLO, gamble, whatever. And I'm more focused on what's the best asset to own from a compounding your capital perspective. And it's,
Yeah.
in my opinion, not the L1 tokens.
No, I mean,
Is it
I agree with
is it
you.
any crypto tokens though, Pranav? Because you're just specifically talking about like if you say tech stocks are going to do well, is there a basket of crypto tokens that you think will outperform?
Um, yeah, I think, when I look at the space today, I can probably name two or three. Again, I'm not going to name it here because like it's not worth it. But like I could always find two or three that I think will perform better than most of my equities in my book. But
Hmm.
it's very, very,
Um,
very few.
Absolute or risk adjusted?
Absolute. So risk adjusted is a very
Okay.
different conversation. Yeah.
Yeah. If you're an allocator, you're going in a year end, you're going to make a decision of how to express a view on crypto. These allocators make decisions on a yearly basis, maybe multi-year time frame. They are still catching up to, hey, last November, Trump got elected. You got all this policy this year. You got Stripe doing acquisitions, BlackRock and Larry, because really getting behind tokenization. What is your outlook for the next year, couple of years? Does that make you incrementally more bullish in the next year? Like, do you think the market's cooked now? Like,
Yeah.
how are you
So what I
expressing
do.
your thesis?
Yeah. So as I mentioned kind of throughout this conversation, I think the number one focus for us is let's look at the public tech companies that are, you know, doing their thing but could leverage stacks pieces of the blockchain stack to, enhance their core business, and as a result use that as an accelerant, right? So that's kind of like where our focus is going to be probably for the next 24 plus months. But while that is happening, I also have a thesis that there are crypto native projects that have tokens or are likely going to have tokens that are just potentially really good projects that are just mispriced completely. And I have a belief that those things will just asymptote down to a point where the cash flows they'll generate will be relative to their market caps will be at a reasonable enough entry point where it will make sense to step in and buy those. I don't know when that will happen, but I think it's going to happen in the next 24 months.
So are you buying like all of DeFi and
No,
only DeFi?
right? No. I
Because I
think
mean
there are
that
things. I think there are things in Deepin that actually will get to a valuation relative to that because there's a catch up that's happening in both directions, right? I pull up any Deepin token, it's down only, right, since the last cycle,
Mhm.
and some of those are actually starting to generate cash. And there's going to be this inflection point where the market cap will get low enough and the cash they're generating will get high enough, and there's going to be a moat, hopefully, that you can say, okay, this is a pretty well priced asymmetric trade I can step into. We're
Mhm.
just not there yet.
As
But
a
I think,
yeah,
yeah.
as a fund, do you use Bitcoin as your primary hurdle rate or your historical returns? How do you think about
Yeah.
like Bitcoin in your portfolio and outperforming that? Because the reality is 9 out of 10 funds don't ever
Yeah.
outperform Bitcoin.
Yeah. So we essentially have two kind of benchmarks we look at, right? One is a market cap weighted top 100, which kind of ends up with like primarily Bitcoin, ETH, and a couple other things. Like that's because that's, if you look at it by market cap, that's the composition of it. And the other one is um, altcoins, essentially, which is, top 100 tokens equal weight. And um, we look at both. I mean, the one when the benchmark we kind of looked at when we started the fund was the altcoin benchmark because it was good. I thought at the time it was going to be the harder one to kind of compete with because in a bull market we always think alts outperform Bitcoin. Again, this was a different sort of cycle if you want to call it that. Um, so those two are my benchmarks. But as we are starting to kind of look at the public equity universe more and more, we are asking, is there a benchmark, right? And I think the short answer is there isn't necessarily a benchmark. At this point, I can only really compete with myself, which is I look at our returns the last 3 years. What's the compounded annual rate of those returns? And can I continue just compounding that? Because that's really what I think the greatest investors did.
Mhm. Yeah.
They just wanted to compound their capital faster than
Mhm.
most of their available instruments on a risk adjusted basis.
We've had a couple of investors come into the spot and say, "Hey, listen, I just put on a big position in Ethereum or Bitcoin and was patient over 5, 6 year time horizon, took money out, and called it a day." Then you have other very sophisticated intellectual fund managers that have done a lot of asset selection and haven't necessarily outperformed Bitcoin, maybe have traded in and out. Um, what what is I mean, what we can talk about what has been successful historically, but the more interesting question in my mind is what do the next 3, 5 years as an allocator mean for this space? Like, you could over intellectualize deep in and DeFi and some other sectors, but the reality is, if you look at the correlation between Bitcoin and M2 and all the other crypto assets, this is just a levered Nasdaq play. So don't
Right.
overthink it. Like, if you're going to invest in this asset class, it is just going to be very volatile, and it is just going to, in the best times, outperform technology, in the worst time, meaningfully underperform it. So make sure that your fund is structured in a way where you don't get people calling for capital in the worst of times, and you can hold on and not have to sell the bag. Don't use leverage, have a 5, 10 year horizon, and honestly just chill.
Yeah.
But it is so hard to do that.
I think you can manage risk around the margins, and that has a meaningful compounding effect, right? So again, we've kept everything very simple, which is my job is to own basically 15 great assets and position them right in the book. Like my highest conviction ones, I think will drive all my returns, position them bigger. One of the things we always do is like, in any given year, we'll have 15 plus bets. And at any given time, 2 or 3 will really start to work for the right reasons. And what we then try to do is reallocate from the losers in the book to the winner, double down as winners. And again, that has an interesting return effect in the book. But I think the other part we do alongside that is ask, how much units of risk do I want to have in this market? And Santi and I, I've talked about this. When everything feels asymmetric to the downside, you want to have more cash than usual. You want to have hedges on, but you don't want to constantly keep hedging, constantly keep raising cash. So you try to do it, you know, a couple of times a year when things feel asymmetric to the downside. And hopefully you get them right. If you don't get them right, you make sure you have your risk back on. So
Mm-hmm.
it's not about like the extremes of like no risk, all risk. It's about like reducing, if you're $100 long, maybe getting that down to like $70 long, having 30 of cash. If you're wrong on raising the cash, redeploying it very quickly, just
Mm-hmm.
acknowledging you were wrong about it. And then if you were right, that's great because now you have $30 of cash to double down on the assets you believe in. And if you do that over time, and if the market just grows and you pick the right assets, that should have a compounding
Mm-hmm.
effect. But trading the market shouldn't be like the place where I mean, at least for me, it's not where I generate my alpha. It's asset
Yeah,
selection.
no.
The trading is an accelerant.
Yeah. Historically, liquid funds have done very well because tokens have allowed you to have a venture-like um, asymmetric return with liquidity in
Yeah.
a 2 to 3, 4 year time frame. However, now you're seeing companies like Polymarket and Ripple really get much more interest from institutional money willing to express a thesis. In my seat as an allocator, I could tell you a lot of LPs, potential LPs, institutional folks have expressed hesitation towards tokens. And so now you have an incredible amount of interest in Polymarket secondary from everyone under the sun at a $15 billion valuation, 9 to 15. Do you think that going forward, venture like strategies that are investing in equity, so now equity is more interesting for crypto, and you could see more companies go public as you're seeing this cycle? I know your fund is structured more on, you have a very flexible mandate. You also have VanEck venture funds, which I'm an investor in, so full disclosure. But I'm curious, like, does this warrant like a shift in thesis? You're looking at Polymarket and Ripple raise these mega rounds. Does it
Yeah.
make you incrementally more inclined to take the liquidity risk and, invest in venture equity structures without the token?
Um, Short answer is there's only a limited amount of that I can do, right? Because we are supposed to run a liquid book. So if we do illiquid investments, that we have to do that as a side pocket essentially. Um,
But you
So,
could
but
do,
we,
but you could do a growth round. You could invest in Polymarket right now, 15 billion. It's like the Mark Rowan Apollo
yeah.
commentary says, illiquid markets are no longer that illiquid because there's a lot of interest in secondary, right?
Right, but I think more from a fund structure perspective, this we don't try to do too many of the illiquid investments for a variety of reasons. But one of the things we look at them, and we've done a bunch in the past. Um, you're right. Like I think I almost when I look at some of these equity investments in what I would say blockchain adjacent businesses that are private today, I kind of look at them as like I think these companies, if my thesis is right, will actually exit as tokenized equities. So call it an equity, call it a token. I don't really care, but I think it'll be a programmable asset that is their equity. Um,
Hmm.
yeah, I know Yano and I talked about it. What do you think about it, Yano?
I'm just waiting for you to tell us if the market is topped or not. I'm kind of I just want to hear, am I buying the coins or selling the coins, Pranav? Come on, get to the point. No,
Okay, I sent you this tweet that Hunter kind of put out there, right? Which was,
I went to the liquid fund dinner thing last night, and it was like I have never seen a more distraught group. I shouldn't say this because good people, and I'm sure some of them listen to this. People have no clue what is going on in this market. Guy to my right dumped everything. He's out. The whole market. He's out. Guy to my left just levered long. Market's down 25%. Levered long. Guy across from me, he's raising for a DAT. The other guy across from me closed all of his DAT. Isn't allocating 10. Like I've never seen more dispersion between investors in the cycle, which is great. It means a lot of money will be made.
yeah,
But it's like there's really no consensus trade right now. And so that I was joking before
yeah,
about, but I do
yeah,
want to
yeah.
hear your take about just how you think about this market.
Yeah, we in our strategy have more cash than usual. Again, I don't believe in sort of being in those extremes of like levered long versus all like
Yeah.
de-risked and like that. That's like too crazy, right? Um, I think we're in a market. So there are markets where you'll have your 10 out of 10 ideas and there are markets, and then also you'll have your 7 out of 10 ideas and you're kind of fully invested. And your 7 out of 10 ideas are 7 out of 10 for a set of reasons. And but then ultimately adds a little bit of diversification and might have a different return profile. So you have it on, right? Since September, we've taken the stance that we only want to have our 10 out of 10 ideas, and our 7 out of 10 ideas are worse. Would rather just be in cash for that piece. So we've been in that position. That served as well. I continue to believe that. Part of
Wait,
that,
but why would you ever want to own a 7 out of 10?
because part of it is like how much. If all you're in is 10 out of 10 ideas and that's 100% of your book, then you might end up with like 5 concentrated positions for your entire book, right?
Mm.
Um,
And is that an issue?
For certain investors, it might be, right? Again,
Yeah.
like PA, like your personal account, people might have a completely different risk appetite,
Mm.
right?
Mm.
But m- people have different. Like I think people want some limitations on how concentrated each individual holding can be, because you have a tail event and then you don't want to get wiped on a massive amount of your book, right? So point is like again like the way I think about my 7 out of 10 ideas is that I have less conviction in them, but that less conviction is made up for in a higher amount of upside. So
Yeah, but portfolio sizing comes into
yeah,
allowing for that
yeah,
7 out of 10.
yeah.
Yeah. Do you
So
think that factors into how markets and how things catch a bid? Like you talk about units of risk. You
yeah,
are maybe in an environment where when there's abundance of liquidity, i.e. M2, rates go low, there's an excess of cash, like QE kicks off or whatever.
yeah,
You're people want to go farther out on the risk spectrum, and so they're more inclined to bid that 7 out of 10. So
right,
again, if you think we're going into a bullet like prolonged and bullish environment macro
yeah,
wise, which is kind of impossible, but say in the next 6 months, rates continue to go down, people are going to want to go chase opportunities farther out on the risk spectrum. The 7 out of 10 from a return standpoint may offer more asymmetry. So you're going to be very compensated to put that position on and size it pretty
yeah,
aggressively if you
yeah,
think that's going to be the case.
yeah,
But again, unless you think there's going to be continued volatility and you say, gosh, I'm taking way too much risk right now to put on a 7 out of 10 because I don't know how this market's going to go up or down. We're a tweet away from the market puking 15% or going up 50%. I just don't know. I don't
Right.
want that volatility in my book.
So I generally agree with your framing around the macro, which is rate cuts, more liquidity. Economy seems to be getting weaker, which means, well, again, great for risk assets if we expect central banks to react the same way as they always have. Trump's going to appoint the new Fed chair at some point. All that, like that looks interesting, right? I guess what I would say is the risky capital is not in crypto. Like that 7 out of 10 idea you want to express that in is somewhere in AI or AI adjacent. It's just not in crypto. So because I just think the story isn't that great in crypto anymore, right? For most of these alts, like what's the most exciting story in crypto? Like narrative wise, right?
Well, it's a good point because I guess prior cycle AI wasn't as much in the narrative. So crypto became that asset where people went to the casino to get out of their current
Right.
financial situation. Right now, people would rather punt Nvidia and options around Nvidia and your incremental AI company versus go to the crypto casino.
Right. Or even I'll take it out the risk curve for you, right? I think, Sam Altman's on every podcast, Satya Nadella is on every podcast talking about the bottleneck in AI being energy and power. And now as a result, you're seeing a lot of speculative money go into energy and power trades, right? Bitcoin miners is one example of it. It's the same theme. People are looking at,
Galaxy.
yeah, renewables, whatever. Like just look at anything in energy and power. Like that's where people can use their imagination and speculate, even though it might never come to be real. Some of these things might never come to be real. Like some of these nuclear stocks, like, I mean, like, $0 of revenue and obviously like tens of billions of market cap, that whole thing. So so you might be right on the macro. It's just that if you're trying to express that view in altcoins, you're expressing it in the wrong place.
Yeah.
Hmm.
I mean, could you then just be so distill the thesis for crypto as it is a place where historically people wanted to express a long gambling view, and now maybe that's no longer going to be the case because people are disillusioned because the infrastructure sucks and pukes, at least when you don't have to deal with the security nonsense, you don't have to deal with all on the margin, it's just hard. So is it that historically, I think a lot of the demand for crypto came outside the US where you didn't have the opportunity to invest in the US stock market and all the technology kind of wealth creation there, or in the private markets?
Yeah.
So two phenomenons. As people have more opportunity to invest in secondary markets, does that diminish the demand for crypto tokens? And more importantly, as kind of the rest of the world has more access, or as the UI UX or the opportunity to invest in technology X crypto for the rest of the world improves, like, does the demand for crypto just go down in a way where it's no longer the venue where people express a long technology view, levered view? Like you just sort of lose a 20, 30%
Yeah.
of the demand that would always have been there. Now people are
Yeah.
like, you know what? This shit's too complicated. I'd rather
Yeah.
express it somewhere else.
I mean, feels like it, right? I think if I were to put it simply, objects in motion stay in motion, which is, whatever area of the market is making people outsize returns, especially this, call it retail capital that wants to gamble, like whatever area that market is giving them those returns, they're going to keep speculating in that area until they drive it into a bubble, and that bubble inevitably will pop at some point.
So Pranav, let me ask you what to do. Let me use actually my scenario as a real scenario, which I think is the scenario of a lot of Empire listeners. So you have things that you don't want to hold long term and that you do want to hold long term. And maybe the things that you don't want to hold long term are some of the riskier crypto assets. And let's say you're out of those already, or you're not out of them and you just want to hold it. So we'll put those aside. But then you have assets that are really good, that you consider to be really good. I'll use Coinbase and Robinhood as two of those. Like for me, I consider those. I want to hold those assets for the next 20 years. Right. So I love Coinbase. I love Robinhood. I want to hold both those stocks for the next 20 years. I think they're going to be huge companies. I also think the equities market is really frothy right now.
Yeah.
And it feels like a good time to get into some cash. But I don't want to but everything I've read says trying to time the markets is a fool's game. So
Yeah.
maybe it's better to just close my eyes, be okay with what could be a 50% drawdown, and just hold what I think is a generational asset. How do you're a
Yeah.
professional trader and investor. If you're not a professional trader and investor, how should someone like me play that scenario?
So I should, I guess, disclaim not financial advice. Like, don't listen to me. But how I think about it is I have my 10 out of 10 ideas that I think are generational assets that will just keep compounding. Believe in the founder, believe what they're building, all that stuff. What's interesting about that is whatever those might be for you, whatever those might be, ignore that. But at least for me, those 10 out of 10 ideas have performed extremely well this year. Like, so they're not the
Right.
assets that are down 60%. So, so the world is rewarding good assets in some ways. So in my opinion, I have my 10 out of 10 ideas and I'm going to let it be as is. I've cut all my 7 out of 10 ideas. I have a fair bit of cash. And interestingly, those are the ideas that I've actually not done well. So I feel generally okay about how things are going. And if my 10 out of 10 ideas go down 50%, well, thank God I have all this cash. Hopefully I get to double down on my best ideas at a hopefully a better entry point.
So
if it doesn't
get
happen,
the cash,
yeah,
get the cash with the 7 out of 10 ideas, even if they're down 20% already or something, because they could, if you don't have conviction in them, why are you holding them in the first place? And then if you've got
right.
10 out of 10 conviction in something,
Yeah.
don't get out
Yeah,
of that.
and I'm not gonna say where are we in like the risk asset cycle, right? Because I think the entire market seems more or less held up by AI. So everything outside of AI just seems to be performing very poorly, right? I don't know. Like I was listening to the Kava and Chipotle earnings calls, and like it's like the way the CEOs are talking about what's happening with the consumer is like, oh my
Yeah.
god, like the world's falling apart, right? So it seems like the market more or less is held up by people's excitement around AI. And at some point, whatever set of catalysts can change that, it doesn't seem like it's, anywhere near current timeline. So it's more that, okay, so that's the way the market is. I want to have a lot of dry powder for if and when that thing changes, but it's all about how much of the upside you want to continue to participate in.
I listened to a great podcast by Shane Parrish on Farnham Street, and he interviews this guy called Anthony Scipigliotti, and he was a guy who exposed the Enron fraud, and he draws a lot of parallels on like where we are in the market. His whole point is that there's just a lot of nonsense happening on an AI, where like NVIDIA like invests in OpenAI, and OpenAI, like Microsoft invests in OpenAI, and they're all kind of like,
Yeah.
it's a huge loop. He draws parallels on. He has a great line which talks about like Alcatel, Lucent, some of these companies that were all the rage when like fiber is being deployed, like these companies no longer exist. Yeah, maybe
So
Mike also
I've
picked
thought
up
about.
on.
I'll give you so I've thought about this sort of criticism a fair bit, because when everything's kind of like so frothy, it's always good to sort of think about what are the red flags and all those types of things. The two counters I'll make to this is that the people that are sort of, let's say, involved in these related party like transactions are founders and CEOs that have been great allocators of capital and great managers and great builders of business for decades and decades. Like it wouldn't make logical sense for me to see all of them sort of engage in, let's just say irrational behavior. I could be wrong. Like, these great CEOs all of a sudden all like get deluded into believing in some great trade, and they all do something stupid, right? Could happen, but I just don't think it's likely. The other part I would say is I just start top down, right? What is driving this entire thing? It's clearly OpenAI. How many users does OpenAI have? How much time does each user spend on OpenAI, and how much they pay for their service? I just think OpenAI ChatGPT is massively under monetized. So
Yeah.
I think the better question to ask is if the revenue per user in OpenAI and ChatGPT was appropriately monetized, what is that number? And how much revenue does OpenAI generate? And what does that mean for the ROI for everything else in the stack? And is that unreasonable or reasonable?
This episode is brought to you by Zcash, the decentralized digital cash that is encrypted to ensure agency and safety. With a fixed supply of 21 million and proof of work consensus, Zcash is encrypted Bitcoin. Buy, store, and spend encrypted Bitcoin using the Zcash-powered mobile wallet, Zashi. To find out more, visit their website or click the link in the show notes. Thanks to Zcash for making today's episode possible. Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion cat campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply.
Yeah, I mean, look, just to put it in perspective, back to crypto, OpenAI, potentially, there's rumors of it going public at $1 trillion valuation. It has 800 million active users. Crypto has 40 million active users for $3.5 trillion asset class. Yano, I can see him. He's going to say, wait a minute, active users, not all
I
users.
saw your response. That's a fair.
There's way more users in exchanges. I said, is different. Cash flow generation, blockchain, like stream of cash flow into apps and protocols, you got to look at the actives, because if you're in an exchange, the exchange is just using their omnibus account. It's not actually deriving fees back to the blockchain and the infra. So sometimes I look at that stat and I say, gosh, does that just make you want to close your entire book in crypto and say, look, maybe I'm going to sit this one out because things have just gotten wildly overvalued? Like, okay, if you buy Bitcoin, maybe Bitcoin, exclude Bitcoin because Bitcoin is like a weird asset, commodity, sovereign store of value. But all the other shit, like Ethereum's the current, like you could buy secondary in OpenAI and SpaceX and Stripe and Revolut.
Well,
Polymarket.
I think,
or would you rather go buy Ethereum? Like, I guess like the number one construct for tokens has been it's liquid, so I can punch in and out. I'm gonna say, yeah, but liquidity can drive really fast. Maybe not for Ethereum, but for your Ethereum X10 market cap. Good luck. Good luck trying to offload that in a bear market. Like, yeah, you're not going to. So you could definitely offload secondary shares. Like you could transact SpaceX and Revolut and maybe not Stripe because they'll ROFR, but like pretty much everything else, it's super liquid. More so than your liquid shitcoin.
I mean, Santi, to your other question, or at least the way you framed it, right? Like, I started this fund in June of 2022. There were probably 10 million active users on chain then. You said the number is 40 now. ChatGPT went viral probably October of 22, and it's now sitting at 800. Isn't the answer there, which is the world told you what it thinks is a killer app? Like, if someone downloading a self-custody wallet and flipping tokens around on a DEX was a killer app, it wouldn't be sitting at 40 million.
There's so many people that can gamble paycheck to paycheck.
Right.
Like there's just so much churn. It's definitely more than 40. You're just churning through that high base constantly because you got pretty much now every other, at least once a month, you have these high vol days where people get liquidated and they got to get another paycheck or a stimulus check and then come back to the casino. It's a constant reset. I mean, I don't need to express why, but I'm deeply bearish on just that use case. That is never going to get us to 200 million, 400 million, 500 million actives. Like, no matter how much you tokenize, no matter how much is there. I mean, and maybe a critic like Kyle or someone might say, dude, you're looking at it all wrong. Because the users that are in crypto are higher value, they're younger, they have more disposable income. It's a different demographic. You don't have to, let's put aside the active users. Let's look at the TVL or some other metric. But I don't think you can ignore that metric. I think I'm deeply bearish if in 5 years' time we can't grow that number to at least 300 million actives. Like that would have meant that the app layer doesn't accrue value, meaning deep in applications don't do well. DeFi may or may not do well if you tokenize a lot of shit and maybe you have 10 institutions doing massive amount of volume. The question there is that value actually going to translate to public infrastructure, or is it going to translate into tempos of the world that, may or may not, maybe better off they are buying Stripe equity? So this is the point. I'm really struggling. I'm every month you want to re-underwrite your thesis.
Yeah.
Go listen to. We're jumping ahead to your content of the week, but there's a great Cheeky Pint podcast with the founder, used to be the ex-CIO of Viking, who now has, I think it's D1. You might know
Yeah.
him.
Yeah.
Phenomenal interview. Go listen to that. Re-underwrite your thesis. In the light of the A16Z report, I get all these favorable trends for crypto and whatnot, but it's kind of hard. It's kind of
Well,
hard.
I think I used to kind of mentally have this debate, which is blockchain crypto touches a billion users one day, maybe two different ways. One is like the VC backed founders, pick your favorite VC in crypto. They backed a bunch of founders. Those projects, build something so great that it gets to a billion users. That's kind of bucket one. Bucket two is the rest of the world that has built a great business gets to adopt this technology and get it to a billion users in, some indirect way. Um, I'm firmly in the camp that it's that second way crypto makes its way into the user. It's going to be somewhere in that path rather than the crypto native founder route.
Yeah, Santi, just to play devil's advocate here, because I think crypto markets just go the way of traditional markets. Like if you look at traditional markets right now, a lot of the things are actually going down. It feels like a bull market. It feels like a big bull market for equities right now, but that's being driven by 20 stocks. Like Pranav, you mentioned the earnings call of who was it, Chipotle? Like Chipotle's
Kava,
stock,
yeah.
yeah,
Yeah, Chipotle too.
yeah, Chipotle stock is down like 50% in a year, right? So it doesn't, and a lot of the market is down. And so I actually think people who've grown up in crypto the last decade are used to all of crypto just going up at a certain point. It's not going to be that way because that's not how markets work. It's going to be I don't know, 20 or 30 things drive the whole market. And you got to be in those 20 or 30 things. And that's probably why there's going to be a queues of, an S&P of crypto. And you just probably buy that instead of buying,
Well,
hunting.
I sort of, and maybe it's because I've been spending a lot of time just looking at like public equities that have like traded down or overlooked. PayPal,
Yeah, Pranav, you missed the last
there's
episode where Santi was longing Western Union. So that's
about
where
like,
he's at.
listen, Western Union trades at 4 times P ratio. I mean, I'm sorry, it doesn't take much to believe that that thing goes to 10 times P ratio. They start doing stuff right. If you replace a CEO, if it's some substance on like margin growth because of stablecoin adoption, like I think ultimately, what is your margin of safety? There is none with crypto. That's why you have so much vol in this goddamn thing. People don't know how to evaluate, but also a lot of these things just depend on a series of stacked assumptions. You got to believe that macro is intact. You got to believe that there's going to be more Larry Finks of the world. You got to believe that sovereigns rally around this shit. You also got to believe that AI doesn't nuke. Like you can go down. You got to believe 10 things for your thesis to be intact. Like I want to invest in stuff that I don't have to believe 10 things that all are deeply correlated. And maybe I'm missing out on stuff that, intricacies of the world. I want to believe in an asset that I say, okay, here's a value creation story. I'm going to monitor and focus, and I can compound that. But
Yeah.
I mean, Chipotle at 25 times earning. Maybe Bill Ackman has a different view. He's always been super bullish. I mean, I like the Chipotle bowls. I grew up in Mexico. The salsa is good. Whatever. The average PE of the market is still inflated. The S&P trades at like 18, 19 times, right? So it's also like a reversion to the mean, right? Anything to your point around if your historical hurdle has been compounding at X and you're investing in something that has historically outperformed that, you could look at it both two ways. One is, hey, maybe I should be allocating this because clearly I missed it. This thing has compounded at a better rate, like NVIDIA. The other part of your brain might say, well, wait a minute, is there going to be a reversion to the mean? Because things can't keep compounding at the rate that they do in perpetuity. So I've now in this market environment, because I think that we're closer to the end of the cycle than the beginning, I want to be focusing on like mean reversion and things that are either widely outperformed or underperformed. In the case of Western Union, 4 times P ratio, the market trades at 20. Anything above 20, I'm cautious. I really need to your point of our units of risk, I really need to believe that that shit is going to defy gravitational pull to come back to 20. Because most of the money that you'll make is on multiple expansion or multiple contraction. Like you either lose or make a ton of money on the deviation from the mean because it is so hard to kind of like to move away from that in the long
Sandy,
term.
that's kind of the point Dan Sundine was making in that D1 podcast, which is, a lot of the best returners are not like predicting, what revenue growth is going to be for some company relative to market expectations. It's very hard to do that. But what's easier to find is a repricing the multiple. And I would put that as it's actually easier. Like there are parts of that podcast I kind of disagreed with him on, which is kind of how he characterizes like retail investing and what retail has done to the markets and those types of things. I would actually layer that in here and say like multiple expansion is easier to predict if you think retail is that marginal dollars that will come in, because that's what's going to drive a change in narrative, and that's going to drive a change in multiple.
Yeah. Now, the best part of all this, we haven't talked about like news, is that crypto assets don't have a multiple because there's no way of valuing, and the market doesn't know how to value them. So it's great. Don't ever show traction. Don't ever show this. The Silicon Valley kind of meme, right? Is like don't ever show revenue. Sell the dream.
Right.
Now Ripple is in an interesting point now, which has just raised 500 million at a $40 billion valuation. XRP trades at 150 billion. You survey 100 people in the street, they'll know what Ripple is. They can't even pronounce Solana. Very interesting. So it's a social phenomenon. It's a meme. It's an attention economy. I get it. So yeah, it's kind of a very weird market.
Yeah.
But I'll leave with one thing, Yana. I know you want to wrap.
Yeah, I got to jump in.
Which is prices in general for alts and all these things are down, and we're all collectively talking about why they are and why we continue to sort of think the space is not, at least this altcoin space is not maybe not going to do extremely well in the next several months. I'm of the opinion that if certain alts start to perform extremely well for a reasonable amount of time, I always want to jump in and ask why and what am I missing, and always just reevaluate, right? Because like you don't want to be the guy that's obviously bearish at the lows kind of thing. So at this moment, that's what I'm very hyper aware of, which is I am bearish as things in altcoins as things drift lower. But if something starts to perform well for, let's just say, the right reasons that seem sustainable, then you got to change your thesis.
You're like George Soros. Famously, there's a guy that says he would have. What is the book? His book called like talks about reflexivity. And he said he would have called George at like 9:30 in the morning. He would have said, "Oh, I'm bearish the market." He called him before. He's like, "What are you talking about? I flipped bullish at 9:37." And the guy famously made investment decisions because he had back pain. That's how he knew when to sell or buy. I will say, Pranav, I have an immense respect for you because I've looked at your letters. I've in conversations with you, especially in days. You can flip bullish and bearish very quickly, and you're not afraid to change your mind. And even though you talk about compounding and long term, I think capital preservation is top of mind for you because you want to have that ability to express and step in with conviction. And I think that's like having those two skill sets is very hard, right? Because typically you hear hold, forget, or trade constantly. But yeah, you're one that I think has not been afraid to like flip bullish or bearish in a very meaningful way in your portfolio and re-underwrite. Like it's the true embodiment of re-underwrite your thesis and change your book, putting aside all other stuff that might, so that I think that's a rare skill to have.
Thanks, man. Appreciate it.
Yeah.
I love your
Content of the
haircut.
week. Yeah. Content of the week, Pranav. We always do content of the week to wrap this up. Mine is I mentioned it earlier, but Andrew Ross Sorkin. I'm reading. I'm like 3 or 4 chapters in. I think probably forget. I don't know. I'm audio booking it, so I don't know exactly how many chapters, but listening to it on Audible, it's good. It's Andrew Ross Sorkin actually reads it. It's like I don't know. I like these deep dives into financial history. He does a really good job of like personalizing it, I would say, where, I read a lot of history books. Sometimes they can be a little dry. He does a very good job of getting into like the people behind the Great Depression and 1929 and the big crash and all that kind of stuff. So I would recommend it.
Definitely read it.
Yeah.
Pranav, any content?
I actually was going to say, I've been listening to the Cheeky Pine podcast. They have incredible guests. Like I'm like, they have like, I think the Bridge guys on the last episode this week. So I'm excited to go listen to
Zach and the Henry, I think from Privy, they're on. I haven't listened to that one.
Yeah.
Well, I said mine earlier, so Shane Parrish.
I'll give you one more actually. I don't know this person, but the guy from The Big Short, Steve Eisman, I think is his name. The guy who plays like Steve Carell in the movie, he's got a podcast too, but he's obviously like a TradFi guy. And like during earnings seasons, he does like a great earnings like recap in like 40 minutes of different companies and why they're relevant to the markets.
Oh, interesting.
Great way to get a feel. Yeah, I would recommend that.
What's the show? What's it called?
I would just look up Steve Eisman. I listened to him on like YouTube.
Nice. That's a great movie to watch in a day like today or yesterday. Fun fact. So that I know we've been talking about bearish and skewing bearish in China. When stocks go down, they are green. When stocks go up, they are red. This is because red is prosperity in China. But I think we should be like China, ladies and gentlemen. When you see something falling and it's greater than 7 out of 10, you should like that asset more, not less. But very few people actually think like that. So again, flip the color on your screen.
Exactly. Santi, good to see you. Pranav, thanks for coming on, man.
Thank you.
All right. Thanks, guys.
There, guys.